Miners, not ETFs, are the unsung heroes building Bitcoin's financial backbone. Since the April 2024 halving, Bitcoin miners have evolved into systemic stabilizers, positioning themselves as critical players in BTC native finance through strategic balance sheet management and liquidity strategies. But here's where it gets controversial. ETFs may dominate the headlines. But the real architects of Bitcoin's liquidity are the miners quietly building balance sheets. And this is the part most people miss. While institutions celebrate inflows, miners are doing the hard work of anchoring Bitcoin native finance, BTCFi. From hash rate to balance sheets, the post-halving pivot has been a game changer. No longer content with selling block rewards at market, miners began behaving more like corporate treasuries, timing BTC sales, collateralizing reserves, and building financial buffers. As of mid-2025, statistics show that Bitcoin miners collectively hold over 104,500 BTC, roughly $12.7 billion, while corporate treasuries added 159,107 BTC in Q2 alone. What appears to be passive hodling is, in fact, a deliberate liquidity strategy, one that reduces exposure to short-term volatility while preserving long-term upside. This shift coincides with aggressive growth in network scale. By mid-2025, Bitcoin's hash rate surged past 970 million TH seconds, achieving almost 60% year-on-year growth. As miners scale up operations, they're also expanding financial exposure, treating balance sheet management as strategically as hash rate optimization. We're witnessing a full-cycle pivot. Rather than merely producing Bitcoin, miners are actively shaping its capital markets. Treasury-driven mining is built on three pillars of strategy: collateralization, timing, and liquidity buffers. Collateralization allows miners to borrow against BTC holdings to fund operations, enabling tactical spending without giving up long-term exposure. Timing involves treating BTC sales like macro trades, holding through downturns or locking in gains during rallies. Liquidity buffers provide a cushion for market stress, giving miners breathing room when network fees or hash competition spike. Public miners that maintain transparent BTC holdings and avoid forced sales are often viewed as more stable, strategic, and better aligned with institutional expectations. Naturally, the 2024 halving didn't create this mindset, but it certainly accelerated it. Post-2024, these financial strategies became necessary for survival rather than merely optional. Miners have begun sending deliberate signals to the broader ecosystem. Holding BTC is about more than just a belief in the protocol now. It's a message. This asset matters, and we're managing it accordingly. When large public miners delay sales, markets take notice. Their actions now influence sentiment and pricing, much like central banks adjusting interest rates. This dynamic used to be the domain of exchanges, not anymore. Some countries are now exploring BTC for strategic reserves. Chainalysis even published a report on the subject earlier this year, pointing out the US, the Czech Republic, Switzerland, and others among the prominent supporters of the idea. Meanwhile, major names like Sailors, MicroStrategy, and Marathon Digital are accumulating and disclosing BTC positions with the same transparency you would expect from institutional asset managers. Put simply, when miners act like treasuries, mining itself turns into institutional capital management, setting the tone for Bitcoin's financial maturity as a global asset. Whether the headlines reflect this or not, that's exactly what we're seeing now. Yet while miners mature, BTCFi remains fragile. The infrastructure meant to support this financial layer is still underdeveloped. Settlements remain slow, with confirmation delays limiting composability. liquidity is siloed across fragmented protocols with minimal coordination. Instruments are often trust-based, lacking the neutrality BTC native systems demand. Projects are continuously experimenting custody-free lending protocols, BTC-backed stablecoins. Hash rate forwards, but most of these tools are still in the early stages, far from broader adoption. This gap between maturing miner behavior and underdeveloped protocol infrastructure is dangerous. Left unresolved, it could turn a stabilizing force into a point of failure. If BTCFi stalls, miners could stand to lose credibility just as their role becomes essential. That's why real infrastructure is necessary here. Cross-protocol interoperability, so miners can allocate capital efficiently across platforms. Robust oracles that reflect true market prices and mining inputs without manipulation risk. And incentive models that reward transparency and penalize extractive behavior. Without these, reserves meant to stabilize the system could become systemic liabilities. Miners didn't ask for this role, but they've stepped into it. In a system without a central bank, someone must set the floor. Today, it's miners who are holding reserves, managing risk, and acting with systemic foresight. If BTCFi fails to mature, it won't be because miners fell short. It will be because the ecosystem refused to acknowledge the financial infrastructure they were already building and support the actors holding it all together. Bitcoin turns institutional when miners act like treasuries. And that's exactly what's happening, whether the headlines catch up or not.